started. Thank you all for joining today. We're in the middle of holiday season, so I know it's kind of busy, but thank you for taking some time out of your day to spend a little bit learning about taxes and getting ready for tax season. For those of you who do not know me, my name is Chloe Schottmeyer. I am the Marketing and Communications Specialist here at Grable CPA and Company. I want to just quickly introduce our two CPAs that we have here. Heath Fritz and then our owner, Cody Grable, will also be presenting today. Just a little fun fact about the two of them: just past this 2024 tax season, the two of them combined prepared and reviewed over about 1,000 tax returns. So you're definitely in good hands today. And then a quick couple housekeeping notes. During this presentation, there's going to be plenty of opportunities for you guys to ask questions. So if you have any, put it in the chat or raise your hand, and one of our CPAs will get and answer those for you. And then at the end, we'll also set aside some time for any questions that you have that weren't answered during the presentation. So feel free to ask as many questions as you guys can have and think of. We're here to answer those for you. And then one last note: if you can't stay the whole time, that's completely fine. This session is going to be recorded, so we will send out a copy of this recording to everyone who registered. So as long as you're registered and you're here, you'll be able to see the full entire meeting. So that's everything I have. I will go ahead and pass it off to Heath and let him, give some good knowledge and information about what we can expect this upcoming tax season.
Appreciate it, Chloe. So everybody that's here and that has joined us today, I hope you all had a Merry Christmas, and we're going to spend a little bit of time today to talk about some of the upcoming changes to tax season that you're not going to be accustomed to, that are going to be new for 2025 tax filing season, due to mainly the big beautiful bill that was passed this past year with the current presidency and their administration that's currently working for us and all of those individuals in the United States. So we'll go ahead and get started here. So today's goals: number one, understand current tax law updates affecting individuals. Review specific tax credits and provisions that may apply to people that are in mainly the lower to middle income classes. That's really what the big beautiful bill is all about, is to try to get some additional tax deductions and tax credits to individuals in those lower tax brackets as opposed to the high income individuals. Also, we're going to try to learn how recent changes are impacting your 2025 tax filing. And then identifying some proactive steps to take before tax season begins. That way, when you guys are bringing in your tax documents and getting tax documents ready for your accountants and CPAs, you kind of know what to expect in advance. And that way, we don't have to spend extra time communicating that stuff to you when we're really busy in the middle of tax season. So any information we can get out to the public and to our clients in advance of that busy tax season is what we're trying to do here. So really, slide one here is, what is the One Big Beautiful Bill Act? So this was a federal tax legislation that was signed earlier in 2025 after Donald Trump was in the presidency to really target the middle income earners and the lower income earners in the United States and get them some extra tax deductions for this upcoming tax season. So the majority of these are going to apply to this 2025 tax filing season, but there's also going to be some additional changes for 2026 and even some additional ones in 2027 as well. And these are going to be extending and modifying individual tax provisions. There are some new tax deductions, brand new, that we haven't seen before, some expanded benefits, and some credits that are no longer going to be in existence anymore that we used to be accustomed to seeing in the past. So we're going to come touch on the major ones and also the ones that we think that are going to affect the majority of our client base as well. So starting out, this is really just kind of the total, individual income tax bracket. So if you're looking at that pre-TCJA column, that's what the tax brackets were prior to basically 2018. That was the Tax Cuts and Jobs Act that was passed in 2018. Those were the tax brackets in those years. Then during the Tax Cuts and Jobs Act that was passed in 2018, that middle column there were the new tax brackets, and those are the ones that have been in existence pretty much since 2018. those tax rates were going to, fall off, and they could have potentially reverted back to some of the old rates. But now the one big beautiful bill there has extended those tax brackets, which really it's giving a big tax benefit to, if you're looking at these percentages here, the 28% bracket went down to 24%, and the 25% went down to 22%. And then as well from the 15% bracket down to 12%. And really not a whole lot of major changes in the higher tax brackets, which is what we're kind of mainly talking about here. There's not a whole lot of major tax benefits to the high income earners. It's really centered towards those middle and lower income tax individuals. So right off the bat here, this is one of the big changes for individuals starting for 2025. So individuals that are 65 years or older, they are basically getting an automatic $6,000 deduction per person. So if you're married and you're filing a joint return and you're both over the age of 65, both of you would be getting a $6,000 deduction for being an elderly person over the age of 65. So 2 people over the age of 65, that's an additional $12,000 deduction on top of, your normal standard deduction or your itemized deductions that you would be getting as well. So that's in addition to, and that's automatic. There's no additional, documentation you need to provide or, give anything additional to the IRS to get that deduction. It's basically automatic. But those do phase out. So if you are a taxpayer with more than $75,000 for individuals, or if you're married filing jointly, if you have adjusted gross income, which is roughly your taxable income minus any deductions that you get, is if you're jointly filing, if it's over $150,000, that deduction will begin to reduce and eventually phase out to zero if you're a high income earner. Again, a lot of these deductions and credits, as you'll see, there's a common theme here. It's targeted toward those middle to lower income earning individuals.
I think on that one too, Heath, it's important to point out this is what was commonly advertised or marketed as the no tax on Social Security. So, although that's what was portrayed, that's not necessarily exactly what it means, because someone could be say 69, 70 years old, hadn't elected to start their Social Security yet, they're still going to get this deduction if they're over 65 years old. So this ultimately ended up being a deduction that's basically for seniors. It's not, that's no tax on Social Security, but that is going to yield a deduction that is equal to a majority of people's Social Security. So it is going to result in that. But it's important to point out, everyone over 65 is going to get this deduction, whether or not they have Social Security on their return.
Right, absolutely. And like you said, there very, very well may be cases where, you do have taxable Social Security on your return, and this deduction may not, reduce all of it. So there still may be some additional Social Security income that is taxable, but this does kind of lessen the impact of that taxable Social Security that Cody's talking about there. So,
right. So if we get those 1099 SSAs, we do still need those to report those on the return. Don't just think we don't have to return those in at all anymore.
Absolutely. And then, another deduction that's kind of been a hot topic and been on people's minds with questions that they've had about, tax deductions coming up for tax season is the no tax on tips. So just kind of go over the bullet points here. We'll go into more details on this as well. So it allows a deduction for qualified tip income earned in eligible occupations. A lot of times that's going to be, your bartenders or your, salon workers or your barbers. Those are pretty much the common ones that we see, but not just limited to those, but those are typically the more common ones. Also, there's a maximum deduction of up to $25,000 per year for tip income. So these tips must be reported as income on a tax return, whether that's on a W-2, or if you're a sole proprietor, if you're a barber and you own your own shop or booth to where you're a 1099 a worker at somebody's barbershop, you're basically the sole proprietor of your own, barbershop business there based on your booth that you're generating the income for that barbershop. But The tips that you receive must be reported as income on your Schedule C if you're a barber in this instance. So the tips you need to be reporting as income in order to get that tip deduction on your tax return. So that's kind of a side note there. And then kind of another thing on your, if you're a W-2 employee where you receive tips, or if you're a waitress or something like that, the tips must be reported as W-2 income in order to get the deductions for the tips on your tax return. So one kind of key note here to be aware of is if you are an individual that receives tips and you're not sure if it's included in your W-2 or not, one thing that we're going to be looking for if you receive tips on a W-2 is basically either your pay stub that show, your last pay stub of the year for 2025 that will show, total amount of tips received for the 2025 year. If your employer is not putting that total tip income on a, box 14 code as other information on the W-2 anywhere, we would be needing that last pay stub of the year in order to have you earn that extra deduction that you wouldn't otherwise be getting if we didn't know about it. So if you're not sure whether you're getting that deduction or not, and you've been receiving tips on your income, always communicate that to your accountant or CPA. That way we can know and make sure that you're getting the maximum deduction as possible that you should be getting. So there is, again, a phase out that's going to apply for high earners. So if you're over the $150,000 income limit for individuals and $300,000 for joint filers, that $25,000 maximum deduction will begin to reduce and eventually phase out completely. So if you're making a good living for yourself and you're a high income earner, you're likely may not even get any deduction for this at all. So and then here's a real example here down at the bottom. If a server earns $30,000 in tips for the 2025 year, the deduction is allowed up to $25,000. So then only the $5,000 remaining in tips is going to be taxable. So that's kind of an illustration on how that is going to work. So, and like I said, again, we would need extra documentation of the total tips received for the year. So, if you're just providing us with a number that you wrote down on a piece of paper, that may fly with some accounting firms, but we're really looking for the additional documentation from your employer that shows that total tips received somewhere.
Yeah, absolutely. On that one too, Heath, as far as the Social Security tips, if they're reporting this correctly, the employer being their W-2 should have this information on that box 7, ideally. Of course, we know that's not always the case. So if there's any additional documentation, like Heath mentioned, that can be provided to potentially qualify for this deduction, we would need that as well. And I think, like you pointed out, with related to self-employed individuals, just to make sure that this is still possible to deduct for them. So I know I was talking to a client the other day in the construction industry, and they were actually going to be receiving a tip. Someone already told them that they were very happy with the work they did. It's kind of a rare situation to get a tip in a construction type job or industry, but these things can happen for self-employed individuals, in any sort of industry. So if you have that happen and you have information on that as far as the amount, and have that separately stated on some sort of invoice or that sort of documentation, this is still available for people in industries that don't normally see tips.
Mm-hmm. And another good point there, if you're a sole proprietor or if you're running your own business, in order to get this, deduction on your tips, it might be a good idea if you have, a QuickBooks Online account or you're doing your own bookkeeping, to create a separate income, account as tip income. That way, on your P&L or your income statement for the year, it's going to be separately stated on there, and you can basically, pull the detail for the entire year of every tip from, every day that there was a tip received on the entire calendar year. So that might be a good, addition to some of your accounting that you're currently doing to kind of save you some time at the end of the year to relieve some headaches on having to go back and track that information down. So that might be a good idea to add in an extra income account on your QuickBooks file or whatever, accounting process you're utilizing to keep good records for your business for the year. Another hot topic item that people have kind of been questioning and how it's going to work and what kind of the details of the deduction are going to be is the no tax on overtime. So this deduction applies only to the overtime premium portion of your pay. So very common for people to receive time and a half as overtime pay. So that entire amount of time and a half is not the deduction. It's just the extra, half that you're getting as overtime incentive pay. So for example, if you're making, $100 an hour, kind of just for illustration purposes here, and your time and a half hourly rate would be $150 per hour. Only that $50 per hour would be eligible for the deduction. So that's kind of how the deduction works and what pay is not taxed as income. So it's regularly hourly wages remain fully taxable, so that your regular standard hourly rate that you normally get paid at every single day, not in excess of your 40 hours a week. So in this example, the 100 hours that you get paid regularly on top of the extra 50% premium for overtime, that is not part of the deduction. So any regular base pay hourly rate remains fully taxable there. The maximum deduction is $12,500 for individuals and $25,000 if you're married filing jointly. So if you are married filing jointly, you do have quite a bit of an advantage there. If you do work a lot of overtime, you do get quite a bit of a deduction there. And overtime must be properly reported on tax forms. And we did touch a little bit on this deduction on our last webinar about the overtime and how that's calculated out. So like we said, there are W-2 changes coming for 2026, but not for this upcoming 2025 year because there hasn't been a whole lot of time for those third-party providers to get that form updated yet. So in the future for 2026, there may be a separate line item on the W-2 for where they can report overtime on the W-2. But as of now, we're not aware of that being the case for 2025 W-2s. So if you do work any overtime, it will be up to you to provide us with, that last pay stub of the year or some kind of additional information that we can verify the number of hours that you worked overtime and the rate at which you're getting paid overtime as well. That way we can calculate your proper deduction on the tax return.
Yeah, Heath, on that one's going to be more, more important, I think, than the tips as far as providing some other additional information, because we have no official change, like you said, to the 2025 W-2. They just have some guidance and suggestions on how to get that information to each employee. So I know here internally, we're going to take a couple different approaches as far as putting last pay stubs in W-2s for employers that we were issuing those out for. You can also put some codes in box 14 with that information in there as well. But for 2026, there are official codings that'll go in box 12 to have that information in there. So they're treating this 2025 year as a transition, and it's going to be a little bit messy for everybody to get that done. But if everybody makes sure that you at least have your last pay stub, you should have that information to get that calculation and that deduction on your return.
Absolutely. So here's kind of a real life example that we've kind of seen similar to one of our clients here at Grable CPA. So we got a client that works 200 hours of overtime in 2025. Their normal hourly rate is $70 an hour. So their overtime rate is time and a half. So their total overtime is $105 per hour. So the difference between your normal rate and your overtime rate is the $35 an hour. That is going to be what is used to calculate your tax deduction on the overtime. So you take that $35 per hour difference, you multiply it by your total amount of overtime worked for the year. That gives you a $7,000 deduction in income on your tax return. So if you want to kind of think about, well, I don't really know how much that saves me in taxes. Well, you basically take that $7,000 times the maximum tax bracket that you're in, we're assuming that this person was in the 24% tax bracket, and that is just basically reducing their taxes overall for their total tax bill by $1,680 in reducing their taxes owed. So normally, if you're about break even and you don't get a big refund, last year, and you don't typically owe a whole bunch of money from year to year on your tax return, you may expect to receive a larger refund, basically based on, if you're working overtime, that amount that's not being taxed is going to reduce that income from overtime by quite a bit. So it is a good tax saving tool to utilize, thanks to some of these tax changes from the big beautiful bill there. And then if you want to think about it in a different way, if you worked 8 overtime hours a week, the tax savings would be, based on our calculations, around $3,500. So just to kind of put it in perspective on how much do you have to work per week to realize some of these tax saving dollar amounts here. The next deduction that we think might be applicable to a lot of clients is the no tax on car loan interest. So this is really another tax deduction, which is reducing your taxable income on vehicles that are new, purchased in 2025. So this does not apply to new vehicles to you that are used. So used vehicles do not qualify for this. Only new vehicles that are purchased on a loan. So the interest on those new vehicle loans in 2025 is tax deductible, up to $10,000 for the year. So just kind of some of the information that we will need on the tax return about the vehicle. We will need the VIN number on the vehicle. So if you don't know where that is, a lot of times that is on the front windshield of the vehicle in front of the driver's side of the vehicle. So it's usually right there in front of your dashboard. If you're looking on the outside of the car, you should be able to see it there on that front windshield there. And another stipulation to this deduction as well is the vehicle must have final assembly in the United States. So any foreign make cars aren't going to qualify for this as well. So if you're looking at, Volkswagen, that's a German car, that's not going to qualify, or any other car that's made overseas. A lot of times you're thinking about, I guess Toyota. Is Toyota manufactured overseas? Cody, do you know?
Well, we have some plants here, like in Gibson County. So they make particular models there. So it's really going to depend on, which model too, not only which manufacturer. There is a master catalog for what does qualify. So I think we can put that out when we send the recording. If people want to check those VIN numbers, but they'll be able to check that. And the dealer should also be able to provide that information to them of, final assembly, where that plant was to make sure it's going to qualify at the time of purchase.
Right. So even if you want to kind of get ahead of the curve here, and if you have a newly purchased vehicle that's a brand new, not a used vehicle, if you want to reach out to the dealership that you bought it from, they can give you that information on if it's going to qualify or not as well. And that way you can kind of know in advance, instead of kind of coming into tax season expecting a large tax deduction and then come to find out you don't end up getting it. That's kind of always a bummer there. So if you want to kind of get ahead of the curve, figure out whether or not your vehicle does qualify, you can always provide us that information, in advance, and kind of be ahead of the curve of everybody else in regards to that deduction there on the new vehicles for 2025. So here is an example. So taxpayer purchases a new U.S. assembled vehicle in 2025. The interest on the loan for that new vehicle is $4,200. That entire $4,200 is going to qualify for the tax deduction. And again, it is subject to income limits and reporting requirements. So a lot of times it's going to, be phased out for those high income earners, and people that are making a lot of money may not qualify for this deduction for the car loan interest. So I think now is a good time to open up the floor for questions if we have any up to this point. So let me go ahead and turn on your ability to ask questions and turn on your microphones if you're able to. So if you have any questions right now, now is a good time to go ahead and send those out, or raise your hand, or feel free to turn on your microphones and ask any questions if you have any up to this point.
I have a question.
Sure, go ahead.
That $6,000 deduction for seniors, you said if it's under the AGI of 75K, but then you also said, or your taxable income after deductions. Which one is it, the AGI or the taxable income after deductions?
Sure. So let me get that screen pulled back up again. We can look at it there. So the phase out is for individual filers if they have AGI, which stands for your modified adjusted gross income there is over 75,000 for single filers. So that is going to be, basically your income and then minus any, deductions as well. So typically if you're looking at a W-2, if you have a W-2 where you're making $75,000, but you also have, a deduction for a traditional IRA contribution or something like that, that's going to reduce that $75,000 W-2 income down to be under that limit there. So it is based on your modified adjusted gross income there. So it's not just your gross income, like your salary for your W-2 or your taxable income on your W-2. It does take into account some of those other factors and other pages on your tax return for deductions as well. Does that adequately answer your question there?
Yes, that was the right answer. Thank you.
Perfect. Any other questions so far? Feel free to ask any questions that we've covered on any of these topics so far, and then we'll also continue to have some opportunities for questions on the back half of this presentation as well.
Heath, I got one thing to add while I'm thinking of it too.
Okay.
Like we were discussing before we hopped on here about Indiana in the case of, typically it's a conforming state with the deductions on the federal. So on our recent, webinar we had with continuing ed with Indiana, we talked about how they hadn't specifically said any of these were going to be add backs or anything to that nature. So when you're thinking about the deductions and the savings that it potentially yield on the federal side, it's also going to save you, at least as of now, we haven't heard anything else. It's going to save you on the state side too, roughly about 4.5% of that deduction based on the state tax, and then your typical 1 to 1.5% on your localities as well for Indiana.
Yep, absolutely. So as of now, like Cody said, we're not aware of any of these deductions being added back and not conforming with the federal return. So you do get the benefit of the federal return deduction and also a small amount on your state as well. So unless there's any last minute changes, which does tend to happen from year to year whenever these new changes arise, some of the states do tend to take a little bit of extra time in making a decision on whether or not they're going to conform to the federal rules. But for the most part, we think they're going to conform, and you'll still be getting that additional benefit on the state side as well. Okay, so another topic here, the Trump accounts for working families tax cuts. So these Trump accounts are basically going to be started for children that were born in 2025. So the federal government has decided to contribute $1,000 to children born in 2025 and then going forward as well. So also a side point here, there have been several companies that have decided to also contribute out of their own company funds additional monies to these Trump accounts. I believe Dell is one of them. I think there's another one as well that has decided to contribute to these Trump accounts for young children, with the overall goal to kind of get kids a head start on investing and having a good foundation and base for their long-term financial stability going forward. Some of the other topics here on how this is going to kind of work. Families can also contribute up to $5,000 annually to their children's Trump account. So it's not just reliant on the government to fund these accounts. You can actually add in money to these accounts as well, and they grow tax-free until the child turns 18, when you can actually start withdrawing money from that account. So these funds are invested in basically U.S. stock market index funds. They're very low risk investments. That way you're not there's very low risk to, losing the amount of money that is in those accounts. And they're investing in the overall economy of the United States. One thing that we want to kind of touch on here as well is that if you work for a company, the company does have the option to also contribute to your child's Trump account as well as an additional employee benefit. Now, that's totally up to the company's policy. You may want to ask your employer about it if they're willing to do that. But it is an additional option for employers to contribute to your child's Trump account if you have one open and set up starting in 2026. So those $1,000 contributions coming from the federal government, those will be starting in 2026. As of now, we're thinking it's going to be around June or July to when those amounts will be deposited into those accounts. So one thing you will need to do in order to open up an account is to let your accountant or CPA know. Really, the easiest way to do it is to let us know if we're doing your tax return, if you want us to open or basically elect to open an account for your child via the tax return. So it's basically an additional tax form that we would file with the return that gets sent off to the IRS stating that we wish your child to have that account opened up and then funded during July when they send those monies out to those accounts that had been opened up in 2026. Now, you don't have to make the election to open up these accounts with the tax return. You can do it completely separately, but really it makes a lot of sense to just go ahead and do it with the tax return. We even have a questionnaire for all of our clients every year that asks questions about new tax changes. Do you have, certain things happen to you that you'd qualify deductions for? One of those questions on our questionnaire is, would you like our office to open up a Trump account for your child? So we're going to hopefully have that on there, and that way you can easily mark the box yes or no, and we can easily add that to the return, and there's not something extra you have to do after tax season to open up those accounts. So that's kind of how these Trump accounts will work. So really it's all about getting a head start for young children and young people to have a good head start once they reach that age of maturity at 18. They've already got a good foundation of using some monies if they're in a tight spot for, furthering their education or, maybe even having a down payment on a house when they turn 18, 20. People start thinking about buying houses at that time point in their lives as well. So that's kind of the end goal of these Trump accounts, is to having a early foundation and having the extra time to have those monies grow instead of kind of having to wait until they start earning money when they are 15, 16, 17 years old and starting to work. So that's really kind of the perk of these Trump accounts. And additionally, health savings accounts, there's going to be some expansion on some of the services and eligible deductions and eligible expense costs that you can use those HSA accounts for. So telehealth services are allowed before meeting plan deductible. More health plans will be qualifying for HSA participation in 2026. So if you have a health plan through the exchange, bronze plans will qualify as a HSA high deductible plan that you can have an HSA account if you are under that health plan. Direct primary care periodic fees can be paid with HSA funds as well. And then HSAs will remain triple tax advantage. So if you don't know what a HSA is, really what it's talking about there with the triple tax advantage is all your contributions into the health savings account, you receive a tax deduction for, whether if that's through your payroll as a pre-tax contribution that comes out of your paycheck, or if you do it at, with your bank. If you have a bank account with a local bank and they offer a HSA account, you can just open up one through your bank and contribute to that account to your bank. You do receive a tax deduction for all the contributions. And then the second aspect of that is if you're able to invest those funds in your HSA account, all the growth of those funds grow tax-free as well. And then the third aspect of the triple tax advantage is all the expenses that you're using your HSA for, all your medical costs. There are no taxes paid on those funds when they're used. So like similar to like an IRA, once you pull the money out of your IRA, you pay taxes on it at that time because it's all tax deferred. HSAs are not like that. Once you take the money out and you spend it on qualified medical costs, you still never pay any taxes on that money at any point in time. So those are really the three benefits to having the HSA account there and utilizing the funds in that tax advantageous manner there. That way you're not paying for medical costs with monies that you've already paid taxes on. So that's kind of the whole point of the HSA account there. And as opposed to a flex, spending account, HSA funds, they do not, expire at the end of the year. They roll over from year to year to year, and you don't have to spend them, every single year, as opposed to the FSA accounts. One other thing to keep in mind, kind of going forward with the Big Beautiful Bill, these credits for clean vehicles and home energy credits will be expiring in 2026. And actually, as of September 30th of 2025, the credits for new, used, and commercial clean vehicles have already expired. So if you're thinking about buying an energy efficient vehicle that's electric, where in the past couple of years, those people that have bought those vehicles receive a tax credit for, they are no longer eligible for credits. So going forward, if you're thinking about doing those, you won't be eligible for any tax credit for that purchase because it's no longer in effect. Also, with the energy efficient home improvement credits, if you buy a energy efficient appliance or something like that to where you are eligible for a credit, those credits are also going away. And then the residential clean energy credit, so those are kind of based off of like solar panels. If you're installing those in your home, in the past couple of years, those were starting to phase out. They have been completely ended as of December 31st, 2025. So you really have one more day if you want to, but you may not have enough time to get those in before the end of the year. But just so you know, going forward for 2026, there are no more credits for these energy type efficient credits going forward for 2026. Yeah.
One thing on the vehicles there, Heath, too.
Yeah.
They initially had a hard cutoff on that September 30th, 2025, as far as taking delivery of the vehicle. But they, when there was a couple of weeks left, I think they changed their stance on that a little bit and said if you did have a valid order contract before then, you could still qualify for that too. So, if you have a rare situation where you ordered that vehicle on September 15th or something and didn't take delivery till October 15th, still could potentially qualify for that as well. So somebody's got a rare situation like that, they did change that a little bit.
Yeah, that's good to know. So if you have, in a scenario where you're close to that cutoff, if you do have that invoice or your purchase order before that cutoff date, it sounds like you're still going to qualify for that credit there. So that's good to know. Looking at 2027, I know we kind of talked about 2025 changes and then some changes for 2026. So for 2027, there is a scholarship donation tax credit. So if you have, a tax liability, so if you have income that is generating, taxes owed on your return, if you have a contribution to a scholarship granting organization, you are eligible of up to a $1,700 credit per year per taxpayer. And that's a dollar for dollar credit. So if you donate, $1,700 to a nonprofit organization that provides scholarships to, secondary education, which is basically, K through high school, those donations are basically tax free. You're receiving a dollar for dollar tax credit on that $1,700. So my kind of way of thinking of it is you can either give $1,700 to the IRS, or you can give $1,700 to a nonprofit organization that is investing and giving scholarships to individuals for secondary education. So to me, it's a no-brainer if you have a nonprofit that you are passionate about and that provides scholarships. To me, it makes a lot of sense to provide additional contributions to them. That way, they can provide additional funding to students who are in need of those funds in order to better educate themselves in their lives and their education career going forward. But one caveat here is that the state is required to participate in this federal tax credit. So if you are a resident of Indiana and Indiana decides they don't want to participate in this, you will not get the benefit of this credit. If you're a resident in Kentucky and Kentucky decides to participate in this, well, good news, and you are eligible for that credit for that state. So there's still a lot of unsure clarity about some of the guidance on this tax credit. So the IRS will be releasing new information, throughout the year, next year in 2026, as it becomes available. But right now, we're not sure if you can contribute to a different state than what you're a resident in. So we're really not sure about that. But hopefully, if you would like to, eventually participate in this program, hopefully you can maybe even communicate to, one of your constituents within the governor's office with your state that you reside in, to kind of, announce your support for this program if you're interested in doing something like that. So I think it's really a beneficial thing to do. And you're really not losing any money. A lot of times we see these credits that are only 20% of what you donate or 10% of what you donate. This is 100% tax credit for what you're donating to these scholarship organizations. So to me, it's kind of a no-brainer. And then some of the key takeaways here for filing upcoming tax season. These new deductions may reduce your taxable income more so than what you're used to. So projected for 2025, the IRS is expecting more tax filers to receive higher refunds than they ever have before, pretty much in the recent history of tax filings. We're at overall lower tax rates than what we're used to. And then in addition to that, we have the Tax Cuts and Jobs Act, deductions. A lot of times we see the biggest, people benefiting from the Tax Cuts and Jobs Act with the QBI deduction if they have a business. And on top of that, the new Big Beautiful Bill deduction that we talked about today. These are all aspects of where we think taxpayers are going to be getting larger refunds than they typically have in the past. So another takeaway here, some of the credits are going to be expiring soon, so something to kind of keep in mind for next year. The timing and proper reporting do matter. So like we said, some of those credits are expiring soon, so the timing of some of these things do matter with cutoff dates. Like we said, the clean vehicle, there is an odd September 30th deadline there, which is already passed. But then also kind of the last takeaway here is proactive planning helps avoid surprises at filing time. So our overall goal here is to kind of advise you and inform you on what's upcoming for 2025 tax season, what we're looking for information-wise from our clients. So the more informed you are, the overall smoother process it'll be for filing your tax return once you get to the office and start providing your tax documents to us. We should be able to get your stuff done a whole lot quicker than having to have a whole long email chain back and forth of what all documents are missing and what we still need from you. So let's go to the next slide here. And if you have any additional questions, now would be a great time to send those in the chat or raise your hand, or feel free to turn your microphone on and ask those questions that you have that haven't been answered yet.
I have another question.
Julie, yeah, go ahead.
Okay, so roughly what's the percentage of your income that would make more sense to itemize for charitable contributions rather than take the standard deduction?
Okay, so for itemized deductions, charitable donations are included on the itemized deductions there. So a lot of times what we see in the past with the raised standard deduction is it has made it very difficult for taxpayers to itemize their deductions. One, because the state and local tax deductions has been capped at $10,000, which has actually changed for 2026. In 2025, it's actually been increased to $40,000. So if you're a high income earner, it does reduce and phase out at, I believe, $500,000. So if you're a high income earner, you may not get an advantage of the itemized deductions there, but absolutely, if you have some charitable contributions in 2025, you may actually end up itemizing or more likely to itemize with the change to the state and local tax deductions for itemized deductions. So if you have charitable donations in 2025, I know kind of in the past, a lot of times we've said, well, if you don't have very many, you may not have to provide those because you may not itemize anyway. But for 2025, that's going to start changing again. We may start to see more of our clients itemize with the changes to the state and local tax deductions there, and then the charitable contributions as well. So be sure to track down your charitable contributions because it very well make a difference in itemizing versus taking the standard deduction in 2025. So was that pretty much? Go ahead, Cody.
I was going to say one more thing on that too, that
Yep.
we didn't touch on necessarily in this presentation, but coming in 2026, they're going to have that above the line charitable deduction as well for $1,000. It's per person, I believe. So married filing jointly can get $2,000 without itemizing for any sort of donations to qualified charities. So also keep track of those going into 2026, because if you don't itemize, you can at least get $2,000 worth if you're married filing jointly without itemizing. So it's going to be important to keep tracking those going into the new year.
Yep, and if you are of retirement age as well, one other thing that we typically advise our retirees to kind of consider doing is if they have a lot of donations to charity and they don't itemize and they're of retirement age to where they're required to have RMDs for their retirement, it does make sense to utilize what's called a qualified charitable distribution, to where your donation to that charity can be automatically pulled from your IRA, and then dollar for dollar reduce your taxable IRA distribution, as opposed to doing it outside of your IRA, not getting the benefit for it through the itemized deductions if you're taking the standard deduction. So if that's something that you're not familiar with, I would either talk to your CPA or accountant, and then also talk to your basically your third-party provider for your IRA, if it's through Fidelity, or if you have a broker through like a Charles Schwab or Edward Jones, or somebody that advises you on your retirement account monies. They can help you get those qualified charitable distributions set up to where you're not having to pay taxes on those donations to charity, by also qualifying your RMD amounts for 2025 and every year going forward for those as well. So do we have any other questions on anything we touched on today, or any rumors that you've heard about, in regards to the big beautiful bill, or anything kind of related to the 2025 tax season? Okay, I think we've kind of reached a good stopping point here. It was kind of a little bit quicker of a presentation than we had last go around with the business webinar, but we really wanted to also touch on some of the changes for individual tax return filings for 2025 and some of the changes for 2026 and beyond as well. So if you have any further questions about specific items or credits or deductions that might affect you individually that you don't want to share here in the group, feel free to reach out to our office. There's my email there, our phone number for the office there. Give us a call, and we'd be happy to answer your specific questions about you and how it might affect you individually on your own tax return as well. So I want to thank you all for participating and deciding to join with us today. And you all have a safe and great happy new year coming up in the next couple of days. So enjoy those last couple of days before we get into tax season, before we start asking you to bring in all your tax documents to our office and get your tax return done. So if we don't have any other questions, thank you guys for attending, and we'll be in touch with you once tax season rolls around.